Good evening to everyone present. We are joined here today with Ms. Radhika Piplani, who is an economist and a vice president at Yes Bank. Ms. Radhika has been involved in giving speeches and webinars and lectures to a lot of students across the country, and her experience and her energy matches, the level of quality that you have known to expect from the Consulting and Analytics Club at Guwahati. And we will not. I won't take any more time, because you'll realize throughout the course of this lecture the amount of experience Miss Peplani has. So, without further ado, we'll proceed to I'll hand it over to Miss Radhika Piplani. So, could the chat please confirm if the stream is audible to you?
Yes.
Okay, wonderful. So I'll hand it over to you, Miss Piplani, and
Thank
we'll proceed. Okay, Tanvi, could you please present the screen?
Yeah, sure.
Yes, if we can have it in the presentation mode, perfect. So hello everyone, and thank you for having me here. Yesterday, while I was sitting down, I was just thinking that what should I present to all of you, which is important enough to take away after this webinar is over. And I asked a couple of my friends that when you were in your undergrad, did you understand anything from economics? Did you have any understanding of what is going around the world? And the answer that I got was no. We did not have any understanding. So I feel that the course which IIT Guwahati is doing and this consulting club is doing is brilliant, and everyone who has enrolled for it should definitely make use of it. And because this, I'm sure, will help you a lot in terms of your future prospects, not only in terms of your job, but also if you want to pursue anything in academia, this will be of great help. So I thought of discussing a little bit of economics and finance, a little different from what you would be studying in your, graduation or your undergraduation books, and more in terms of how practically we see this subject and how do we take away from, what the indicators or what data is saying. Next slide. So last year, all of us were in the great global lockdown for two consecutive quarters. We were, more or less at the brink of a recession, or actually, we were in a recession. And not only we, globally, all the people were sitting at home and, just stuck in a great global pandemic. So according to IMF, last year, approximately 90% of the economies were in a recession. So when I say recession, what do we mean by it? So all the economies go through a business cycle. By business cycle, I mean the ups and downs that an economy goes through. Recession is the lowest phase that an economy can go through in terms of its GDP, in terms of its growth, in terms of the output that it produces. So 90% of the economies were at the lowest in terms of the output that they were producing. And it makes sense because everyone was at home. So there was no economic activities that was happening. In the next chart, when we are seeing that the world trade volume last year were at the lowest since the GFC, or the global financial crisis of the 2008-2009. So what I mean to say is that during this recession, we were at the worst that we had seen in the history. And that culminated in what we call as a recession. And if we go through the next slide, we'll see how, the next slide, please. Yeah. So we'll see how world over, the developed market as well as the emerging market economies were saw two periods of contraction in both June as well as, say, September quarter, and then there was slight pickup in the December and the March quarters. Now, what you are seeing now is like a peak that is happening in, say, your June and September quarter, and then again there is some normalization. Now that peak, obviously the economies are recovering, the economies have opened up, and people are going out and spending money. Activities have resumed, factories have resumed. Hence, we are seeing the sharp jump that GDP across the world is showing. But also, this high jump is because of the base effect, which in economics we term it as. Base effect is when you have a very low base in the denominator, your entire number will show in a very, optically, it will be very good. So we might have, say, a number of minus 24% last year. And this year, if we have a number of minus or plus 24%, that is not only because the economic activities have performed well, but also because last year during the same period you had a negative 24. So in some way it is beefing up your number this quarter. So hence, once we are reading economic indicators or economic activities, when we are reading it through the indicators, we have to be extremely careful that which growth rate are we considering. Is it a YOY growth rate, which means are we seeing this quarter's number vis-a-vis last year same quarter's number, or are we comparing how this quarter has performed vis-a-vis last quarter? During this time, as economists, it's preferable to see how this quarter has performed vis-a-vis last quarter, because we are in a progression stage where we're coming out of deep recession. So we need to see incrementally, and that incremental is how you can see, quarter on quarter changes or month over month changes, how incrementally activities are recovering. So India too saw a deep recession. So we posted a negative 7.3% GDP last year, which means FY21. We follow the fiscal years and not the calendar years. This year we are expecting to see a 9.5 GDP. So again, this number needs to be seen in the light that we are coming from a very low base. Hence, optically, 9.5 might look a lot. It might be one of the highest that India has seen recently. But if we understand that this is because India was in a recession, and that is why we are seeing that higher number. Sequentially, if we see how this quarter has performed over last quarter, then there might be some variations. So here, what I have shown you is how on year basis India has recovered. And yes, it has recovered. It has recovered quite steadfastly. But there is more to the data than just seeing the headline numbers. Next slide, please. Okay, so this snapshot is very interesting, and the reason why I have, put across this is because I want you to see the wide variety of indicators that we track, not only in India but also globally. This is just a brief, snapshot of the indicators that we cover. One of it is the industrial production, where we track how the economic activities are performing in the manufacturing sector, mining sector, electricity sector, and then we see what is the growth rate. Then the next indicator that we have is the manufacturing PMI and the services PMI. Now, this indicator I'll explain a little bit because I'm not sure how many of you, understand this. So PMI is a survey-based indicator. So every month, so market is the organization which does this survey. So they send out the surveys to various companies, and they ask the companies whether you're seeing order books flowing in, how do you see inventories, how do you see demand or exports and imports showing up. So it's more of a yes no kind of an indicator survey, yes no status quo. And that is how this index is calculated, and we track it, whether it's expanding, whether it's contracting, how much is it expanding. So now the reason why I have that as a highlight in terms of the two blocks of April and May of last year and April and May of this year, the reason why I have highlighted this in this manner is to show how the base effects, across the countries have been beefing up the numbers. So we have to be extremely careful when we look at any data, but broadly as a picture, and don't read into too much of the numbers that they are showing. Broadly as a picture, what we can see is there is a progress. There is progress of the economies globally from the recession days to now the recovery mode. So, which obviously is a positive sign for all of us. Now, the other bit that you are seeing on the right hand side is the few reds that are coming in the US economy. That is for the consumer confidence index. This is extremely interesting as to why consumer confidence is in red, even though most of the other indicators are in the green area. This is something which I will come to in the later part of my presentation. Next slide, please. Okay, so this is for the UK and the China, the hard data and the soft data indicators. By hard data here, I mean something which you can track, say an industrial production. You can see, you can physically see the activities happening, or you can have it in units. But soft data is something which is, say, a survey-based indicator, like a manufacturing PMI or services PMI. So our database is made up of both hard as well as soft indexes, and that is how we track how the economies are performing. Another interesting thing about economic data is the frequency at which it comes. So GDP comes at a quarterly frequency. Your industrial production, exports and imports, they come at a monthly frequency. We also have data that come out on, say, daily frequency and bi-weekly, biannually. So it becomes extremely important to understand that which data is important and how frequent you want to track it in order to come up with an outcome. And why is that important? Because that helps us in policy making to some extent. So for GDP, it comes with a lag. So as of November end, India got its second quarter FY22 GDP data, and we are at the end of quarter three. So it is coming with quite a lag. So it loses its significance after a point of time because of the delay that it gets released. So hence we need to up our game and understand how we can track these daily and monthly data and understand how the economy has performed in that particular quarter. And this helps businesses, corporates, and banks to make decision because you have to be forward looking. You can't be that backward looking in terms of data, right? So we need to look at whatever data we have and forecast it, that how do we see the trajectory going forward. And that is where these high frequency data becomes more important, and that is why GDP to some extent loses its significance because of its delayed release in policy making. Now here it's very interesting because even though apart from the base effect that UK was going through, we see a lot of reds in between. UK had its own issue last year, and that was due to Brexit. So because of Brexit, there was so much of uncertainty that got reflected in your consumer confidence index, and that got reflected in your exports. So all the geopolitical events that happen globally, any shock that any economy goes through, that is reflected through data. So hence we need to understand what is it indicating and what is the repercussion that it will have on the other economies. Similarly, for China, if you see, China's recession started before us and it ended before us because uh, it went into a lockdown much before the global economy had gone into a lockdown, and it came out of it much before all of us came out of it. So this is something which even the data here shows. Next slide. So, is everything positive going forward? The straight answer would be no. There are a lot of risks that are coming into picture, and one of the primary risks that is coming up immediately is on inflation. Now, COVID-19 has resulted in a structural shift, not only in India but also globally, and that is causing a change in the dynamics of how various commodities are being priced, how demand supply is being undertaken. That is in a way seeping down to how it is getting priced. So both the emerging market as well as developed market countries are facing high inflationary pressures. Now, why is this inflation coming into picture in that big a way? One of the primary reasons is how the oil market has been, reacting. So oil prices have been trading around, say, a $75 dollar per barrel level, and it had reached an $85 per barrel level. And this is when last year, when we were in the pandemic, the price of oil was only $20 per barrel. So do you understand that how much of a year-on-year increase, if I may say, that it has resulted? And this is weighing heavily on all the sectors. Now, manufacturing, in a way, is a major sector which takes in oil, and we are seeing that manufacturing sector prices are going up. Now again, services sector, which includes, say, your trade, which includes, say, other professional services. So all these services sector also consumes some bit of an oil. So now, if the prices of your basic commodities, if the pricing of, say, your copper, steel, metal, cement, so if all of these prices start to inch up, which are your basic raw materials, then at the end this will seep down to your manufacturers, your wholesalers, retailers, and at the end your consumers. So this is something which is becoming a major challenge for all the makers, because last year the policy makers were easing policy, they were pushing in money into the system so that growth is beefed up. Now growth has started to recover, as those heat maps were showing. But now the problem that is coming is, because of so much money into the system, inflation has started to go up. There's so much of money supply, which is something which you must be reading in your economic textbook. With so much of money supply in the system, your inflationary pressures have started to go up. And your output, though it's rising, it's not rising at the same pace as the rise of inflation, which means that there is a supply and demand mismatch. And again, because of the supply and demand mismatch, your prices of commodities are going up, and that is something which is hurting all of us. Because if you know that in the pandemic, a lot of us have lost jobs, a lot of us have been out of employment, we did not get salary increases. Some of us are working at prices which are probably at the same level or even lower at what we started. But if your inflation pressures are going up, then on real basis, which is basically nominal minus your inflation, on real terms, we are losing out. And that is what is the main problem that the policymakers are facing. And hence they are stepping up the game to act on it. Next slide. So I had shown you in my previous slide, in the heat map for the US, that consumer confidence was taking a dip. Now, this is a chart which shows that the consumer confidence for the US is taking a dip. The reason being is that the consumers are worried about the price increases. Now, can you understand that they have come from a pandemic situation where there was no money, no jobs, and the recovery has started to happen? They are spending money, but now again that confidence in the market is going down because they are facing the price pressures. Now this is something which is extremely negative for the consumers, and this is not something which is only happening in US, but in many other economies. And hence what we are seeing, or what we saw in this last 1 week, if anyone has been following the news, US has started, it has doubled the pace of tapering, which means that earlier the amount of money it was injecting in the market, it will now start absorbing or injecting less money. Similarly, even Bank of England, European Central Bank, Bank of Japan, all these banks in the last 1 week have come out to help curb the price pressures, and for that to happen, they have started to absorb some form of the stimulus which they went ahead with last time. So this is like a weighted average chart of global monetary policy rate around the world, and we are seeing that slowly and steadily, after dipping down quite low, the policy rates have started to increase up slowly and steadily. So this is something which we are expecting that this process will continue, and more or less more central banks, whether it's from EM or DM economies, will start raising rates slowly and steadily. Next slide. So, what is there for India? So, India witnessed the most severe shock in the history, whether it was the dot-com bubble, or the Euro crisis, the Asian crisis, Lehman crisis. There was nothing matching the extent to which COVID-19 pandemic resulted. In terms of the sharp, steep contraction or slowdown in terms of growth. So you must be reading a lot in terms of how India has not yet reached the pre-pandemic level of output, or how it is. How there is a severe output gap remaining for India. What does that really mean? So if I as you can see in the second chart here. So I have drawn a trend line of India's GDP growth. So if there wouldn't have been any shock, then India would more or less be following this trend line. And because of the shock of COVID-19 pandemic last year, we saw a large dip happening there. There is recovery in 2022 as we are seeing, but still we haven't reached that trend line. So that is the output gap that everyone around the globe as well as in India we are talking, that we have not yet reached the pre-pandemic level of growth. And this is discerning because with so much of stimulus that both the government and the RBI is putting into the system, we have not yet been able to reach the pre-pandemic level of growth. Now this in 2022, which is like an FY 2022, the RBI expects India to grow at a 9.5% of GDP. Now, despite a 9.5% of GDP growth, which is a large enough number, we still are lacking by quite a margin in terms of reaching the pre-pandemic level. So when will this be covered? No one really knows. Probably next year, probably in 2 more years, we'll reach this level. But again, we have lost a significant chunk of our GDP, through this pandemic, and this doesn't bode well for our future path. Next slide. This is a snapshot. This picture I have taken from one of the RBI's publication, which was released recently, and it's a very pictorial presentation in terms of the various sectors which goes into, say, your growth calculation, and how they are linked in terms of the forward and backward linkages. Now, industry is the main focus for say GDP calculation. And if you see within industries, it's the manufacturing sector, mining sector, electricity. So these are the three sectors which are the mainstay of industries, and how the backward and forward linkages from the industry help in overcoming help in GDP calculation and supporting growth. Yes, services sector is coming up in a big way, but still in terms of the forward and backward linkages, it's the industry sector which is taking the lead vis-a-vis the services sector and the agriculture sector. Now, this is one way of looking at the GDP through the GVA method or through these sectors. The other way of looking at GDP is through the common equation that we all go through in terms of in our textbooks. It's the C plus I plus G plus the net exports. So in that equation, what we are seeing is your consumption or the private consumption is still very low. However, your investment is being beefed up because the government is putting in a lot of money in terms of the investment projects. However, there is another part of investments, which is the private investment. So despite government coming in and putting in money in your infrastructure projects, the private investment has still not upped its game. So basically, the private investors are still not confident in terms of India's growth recovery. It's not very much sustainable, and hence they are not stepping in sufficiently. Now, if you look at net exports, something very interesting is happening there. So even though your exports are increasing at a good pace, what is happening is your imports are increasing at a much more heavier pace. And that is resulting in your net exports pulling down, because net exports is nothing but exports minus your imports. So if your negative of imports is high, then your entire basket will be pulled down. So what we have here is that government investment is going up, your exports are going up, but your consumption is still not high enough. Private investment is still not high enough, and your imports are very large. So all of this together is having a play on how the GDP looks like for India. And until and unless private consumption doesn't go up in a big way, India's GDP will not see a sustainable growth in the longer term. Now, we must have been reading about crowding in of investments. So even though the government is coming in and putting in money in all the infrastructure projects, it's not acting as an incentive yet for the private investment players to come in despite government's effort and put in money. Has it started happening, or will it happen in any time In the near term, yes, there is a possibility because the interest rates are very low. The government is coming up with a lot of schemes so that private investment takes place in a major way. But as of now, nothing major has happened in terms of the private investment space. It's improving, but the pace is very slow. Next slide.
Ma'am, actually, there is a bit of a technical glitch. So, can we take a break of 1 minute?
Sure, no problem.
Yeah, I'll, ma'am, send you a link. So, maybe join that.
Welcome back, everyone. Apologies for the glitch. We'll be proceeding from the last slide. If you may.
Sure. So here I have the snapshot for India. We had seen previously the snapshot for the global economies, and it would have been unfair if I don't show you how our country looks like in terms of the economic indicators. So if you look at all these indicators, again, we are seeing good recovery in all the indicators, whether they are the hard data indicators or they are the soft data indicators. The recovery is looking good. Again, those two highlighted sections have just are there to show how the base effects are beefing up the numbers a little. Another section which I have highlighted, and that is very interesting, this is something which all of us might be, or some of us at least might be seeing in our day-to-day lives, is how the auto sector has been performing. So if you see, there are a couple of negatives in that particular box for next to the auto sector on the right hand side. That is because there is a global shortage of the semiconductor chips. I am sure that with engineers and economists and other students who are there, some of you, if you are going to purchase a vehicle, whether it's a two wheeler or a four wheeler, the amount of weight you know you have to do for that vehicle would be, say, anywhere ranging from 3 to 6 months. and that is insane. So that is because there is demand, but the supply is lacking, and the reason why supply is lacking is because globally there is a shortage of semiconductor chips. But how come there is that amount of shortage, that globally, in firms or manufacturers are running behind the semiconductor manufacturers? How come do we have that high a shortage? The reason for that is that when there was a pandemic, the amount of investment that was going into particular industries had reduced significantly. That and so that has not yet reached the level what it was, say, at a pre-pandemic level. Now suddenly the economies have opened, and suddenly everyone is demanding products which no one had anticipated earlier, that this will be the way forward. Hence we are seeing that there is semiconductor shortage, whether it's the auto sector or it's the electronic sector, whether it's computers and laptops. Everyone is demanding these products at so much that we don't have that much of raw material to supply, and hence what we are seeing is all these reds, which means that the production of these two-wheelers or these four-wheelers or commercial vehicles is not happening at the pace which the companies would want, because there is definite demand, but we are not able to match it up with the supply. So this is a major problem which is happening, and hence you're also seeing that the car prices are increasing, the two-wheeler prices are increasing, because again we don't have enough inventory to match up the demand, and hence we'll have to increase the price somewhat. But again, even that is not impacting. So this is what our data is showing, and it's more or less a reflection of what is happening globally. Next slide. So this is an extremely important indicator, indicator set, and this had started coming used last year only. For those who happen to read newspapers like the Mint, they had last year come up with a separate section or a separate paper only with tracking your mobility indicators. So is this is extremely significant, because last year when all the economic indicators had gone for a toss, we were not able to do such surveys because nothing was there on the ground. We had to rely on indicators given to us by the Apple or the Google. And so this helped us track how the movements are happening across, say, the parks or, the metro stations and so on and so forth. So if you see this, the first two blocks, then during the midst of a pandemic, they are in red. And now we are progressing towards the darker shades of green, which means that the activities are more or less close to the pre-pandemic level. Um, this is both indicated by the Google mobility indicators as well as the Apple mobility indicators. The third set of indicators are the Google search trends, which show you how much of time have we spent at home watching Netflix or in Google classrooms or taking Coursera. So here you'll see the opposite trend as compared to the first two blocks. So during the pandemic period, when we were at home, we are seeing the greens, which means that the usage of these high, online trends, your Netflix and Coursera had increased during the midst of a pandemic. Then, as the economy started to improve, the usage declined, and hence we see a red in between, and then again a green, which means that during the second wave again. We were consuming more of all of these online platforms, and then again we are seeing some bit of moderation starting now. So this data set is very interesting. And now what economists are also relying on is not just the traditional data sources like the industrial production or the PMI. They have been in use, but what is more important now, and this COVID-19 pandemic has made it much more relevant to rely on something which is non-traditional. And this is an example of the non-traditional data set, which has become one of the mainstay for most of the economists now. Next slide. How is India's recovery looking? In simple terms, it's a very mixed recovery. That is because of the charts that you see below. If you look at how the two-wheelers have been performing through the dark blue, bar in the first chart, you see that in 2021, which is this year, we haven't yet reached how the level of 2019, even in terms of your air passenger traffic, which again is a dark blue line. a bar, we haven't reached yet the 2019 levels, which indicates clearly that though recovery is happening, we are much better off than we were in, say, 2020. We have yet not reached the 2019 levels. Next slide. Now here again you are seeing how the GST numbers are coming across in the newspapers. More than 1 trillion GST collection, and 1.2 1.3 trillion. Yes, it's true that the GST collections have increased, which is a good sign that economic activity is taking shape. But on the other hand, if you look at the manufacturing capacity utilization, it means that the resources which these manufacturing firms have, are they getting utilized up to the maximum potential? The answer is no. If you see the last quarter data which is there, it comes with a lag. We haven't yet reached the pre-pandemic level of capacity utilization, which itself says that though there is recovery in some sectors, however it's not yet broad based. There are some sectors which are recovering fast, there are other sectors which are still lagging in terms of its economic activity, and they're still lagging in terms of its growth. Next slide. So what is the key concern for India amongst this mixed economic database? So the main concern for India as of now is inflation. As much as it is there in the global countries, it's also something which is hurting us. If you look at the first graph, then the global food price index is at an all-time high. Thankfully, we have sufficient stocks and sufficient buffers in India. We are a rich country in terms of food produce, but this is not something which is true for other countries worldwide. And when every country is trying to secure at least the food needs for themselves, and the countries were not able to do that, and the import costs have really gone up for food prices, that is where the main pressure is coming into picture, because there are some countries who are self sufficient, there are others which are not self sufficient, and this gap is something which is being captured by the global food price index. Now, how much of global food price index impacts us? It's not much, but yes, to some extent, India also does follow the trend, because it imports, say, pulses or oil seeds from abroad, sunflower oil. So all of these prices are going high, and that is impacting our consumption basket. So in India, we have two sets of indicators that we look at when it comes to inflation. One is your headline inflation, and the other is core inflation. Your headline inflation is a total sum of all the sub indices that you can think of in terms of the prices that you and I face. Your core index is something that it excludes your volatile products like, say, food prices, which follow a seasonality trend. Your oil prices, which again is something which we cannot control, is something that it happens globally, and we just have to take it. It's like an exogenous variable in the equation. So core inflation is, say, what you and I face in terms of health expenditure, in terms of education expenditure. So now, even though your headline inflation is coming down, um, because your food prices are going down, we have good rains which are helping the prices to stay down. But on the other side, your core inflation is not going down. Your health expenditures have gone up, your education expenditure has gone up. So all of these expenses are causing your core inflation to be very high. Now the central bank has been targeting the headline inflation only for the purpose of policy making. Not that it doesn't look at core inflation, but it only concentrates on the headline for seeing how it should raise rates or reduce rates. But now what the problem is coming for India as well is that even though your headline is coming, the pressure at the core is so much high that it's crossing the threshold which the RBI is comfortable with in terms of its inflation. So that is something which is worrisome. But again, because the RBI does not target core inflation, it's more or less okay with how the price pressures are, in the hope that as time passes by, they will reduce to some extent. Hopefully that does happen, because otherwise it will have serious repercussions on us, as it is having in the global environment. Next slide. So these cost pressures, how do us obviously face these cost pressures when we are going to buy vegetables in on the streets, or if we are buying books or journals online. But the companies also face cost pressures through their raw material costs, staff costs, and through their petrol and fuel prices. Now the areas that I have highlighted are showcasing you how much of costs for the companies have gone up. Obviously, last year the companies had saved a lot in terms of these costs, because oil prices were, like I said, around say 20, 25, 30 per barrel. Now oil prices are around 80, 85, 75 per barrel. So their costs have gone up, and this is affecting the companies in a big way. Um, yes, it's true that interest costs that the companies are facing are lower, because the RBI has reduced their interest rates to an all-time low. So that ways the companies are benefiting. But because their fuel costs, their raw material costs have increased so much, that in some way that is impacting the profitability of the companies. Not so much as of now, because what the companies are doing right now is they're cutting their costs in other sectors, in say staffing, in hiking salaries. They're not increasing salaries because they are facing a lot of pressure from say power or fuel sector, or their raw materials have gone up, so they are not hiring those many people, they are not increasing salaries at that level. But will this continue for long? Probably not. In quarter 3 and quarter 4, they might not be in a position to reduce salaries by that much, so hence their profit at the end will suffer a little. Now, how much will it suffer? It depends on how much the companies are able to increase the price of the product. Yes, the sales are very good across the sectors. Mostly, most sectors are doing well in terms of the sales. But when it comes to prices, not all companies have been able to hike the prices to that great an extent, because they are assuming that if they increase the price, the demand will reduce. This is like the basic, the demand price curve that we read in a microeconomics. Next slide. This is again a snapshot of, last slide. Yeah. So this is again a snapshot of how the ratios, which probably you must have all studied, in terms of the staff costs to sales or profitability ratios, how they are looking. Again, this what they are these ratios are hinting at is that interest costs are low, sales are very high, and your cost pressures are hurting the companies to some extent, mostly the manufacturing, but even services sector is not far behind in terms of the cost pressures. Next slide. So overall, how does India look going ahead? Next slide. So like the global environment, like the global countries, even India is going through a lot of structural changes, and to some extent, they are quite positive. COVID-19 has resulted in the biggest structural shift for India, of which all of us were a part of. And now what we are seeing is, through the government's initiatives, we are seeing another wave of how our country can move going ahead. In 2019, India's corporate taxes were reduced for the manufacturing firms. Now this was a big positive when you see from a global perspective, because earlier India had quite high tax rate regime. With this reduction, and India is more or less now in line with how globally competitive countries are like, and that is helpful in terms of garnering gathering some flows from the outside world. The second major initiative that the government has taken is by promoting infrastructure. Like I said before, the private players are not very much interested as of now to invest that much money in India's infrastructure. So the government has upped its game, and it's focusing a lot in terms of the infrastructure development. whether it's the energy sector, whether it's the port or the urban infrastructure, it's likely to receive a lot of funds going ahead. And that is something which is extremely important for any country to move forward, because as you must have read in your textbooks as well, that till the time the government doesn't step in, uh, in terms of getting money into these projects, the private players will not, will hesitate to, invest into that sector. The other major incentive scheme that the government has come up with is the PLI scheme. For the auto sector, the pharma industry, the cell and chemical industry, the textile and specialty steel sector. So these are the mainstay manufacturing sector which the government is focusing on for now, and they would want to promote this sector and make them global players. Now, because of the US-China trade tensions that had happened in 2019, India has, come into a very prominent spotlight. So some amount of flows for, say, the textile industries goes into Vietnam and Bangladesh. They are able to garner that fund. But if India is able to up its game in these sectors which the government is promoting, then there is no way that India cannot, in any which ways, overcome what Bangladesh or Vietnam has been seeing in the last 2 years. So that is all from my side, and hope this is, informative enough. And probably the next time you guys pick any business newspapers, at least there will be a bit more understanding than what it was, prior to this session. And if that is something which you guys achieve, then I think I have done a good job. Open to any questions that are there from the audience.
Thank you so much, ma'am. I'm sure the audience would have found it very informative and in line with what they're learning in the Tech course right now. So we have a few questions from the learners at the Winter Consulting 2021 course. So, Tanvi, can you take this forward?
Yeah, yeah, sure. So the first question is actually very interesting. The person has asked, what do you see the finance sector worldwide achieving by incorporating modern day computer science specializations, like talking about data sciences, machine learning, and artificial intelligence, and the uses in the finance ecosystems, like public and private sector banks, stock companies? And also, like, do you think that these modern day specializations are more useful and relevant in finance sector or in the CS and IT sector?
This is definitely a very good question, because I personally am of the belief that the way forward in this area is through your data science and AI. There is no way that, AI and data science techniques will not seep into any of the sectors. So banking sector is one sector which is already, using this. And if I may say, there isn't any industry as of now which is not using these techniques. So uh, there is no specific industry or sector which can use this, AI specialities or data science specialities. It's across the board, and this will just grow heaps and bounds. So this is like an earnest request to everyone, to all the audience, students, that irrespective of the course, just get hands down in terms of your data science and AI technologies, or to whatever extent you can understand the data better. Because the flow of data, like I was discussing in my presentation, also has changed a lot. And COVID-19 has resulted in that shift, or even in terms of the kind of data that we see and we analyze. As of now, in the economic space, we do see some bit of data that has been going on since a long time. But with these mobility indicators coming up, with these online trends, coming up, there is a different sense that even we get when we look at these real time data. An example of this would be, say, the supermarkets. The supermarkets place products in a particular section basis the data that they get, that who visits that section more often, how much time do you devote at that particular counter, and accordingly they'll place products in that section, and they will price the people also who want to display their products. So it just shows the extent to which the AI and the data science has taken um, has marched ahead, and there is no way there is that any industry will not get this in anytime soon. So it's definitely a must for everyone going ahead.
Yeah, that actually is a really fair point, and talking about its success in every industries also. And yeah, like as you were talking about COVID and its effect on our lifestyles, one question is, has work from home really helped corporate sectors in reducing cost pressure? And do you think that work from home is going to be the future now?
So yes, in terms of cost pressures, definitely for some companies, the cost pressures have reduced tremendously. So I stay in Mumbai, where you can understand that the rental costs of this place are a lot. Apart from a couple of companies in Mumbai, some of the MNCs have still not started, calling their employees to office. And the reason being is that some of the spaces they have either given away, because why will you pay rent for say 1 year if you are not sure what the future enholds. And some companies have started calling employees in batches, and still that persists. So maybe you'll have a 2 day working week or a 3 day working week. So it is beneficial to some extent, because you are saving on the cost of travel, you are doing less pollution in terms of visiting office and using petrol and diesel. So that ways you are helping, and to some extent. In terms of the cost pressures, the company is also benefiting because they are not having the employees, so they don't have to rent that space for a longer duration, or they'll have to just rent out a small space to accommodate people on rotation basis. So yes, definitely companies have been benefiting if they are doing work from home. How long will it stay is something which is very dicey, because now this Omicron uncertainty has come up. So again, the companies which were thinking of calling employees on regular basis, and they have backtracked, and again they have started with that 2 day working week, 3 day working week. So it's very unsure how this will move ahead, and going forward how the companies take it will also be dependent on which sectors you are in. Like say a banking sector, if someone is in the front end role, they will have to come to office regularly. But if someone is at the back end role, probably even once a day or twice a day would work. So it depends upon which functionalities you are in, which role you are in, and which sector you are in. So again, it's very variable.
Yeah, that actually seems a fair point. Yeah, the next question being, why do you think the private investments are not coming in India?
So there are a couple of reasons for it. Firstly, if you track how cumbersome it is in India in terms of getting all the paperwork done, getting the land for the investment projects. It's extremely difficult as compared to say how you would get it in Vietnam or Bangladesh or Sri Lanka. So hence the companies are a little hesitant on that front. Even when it comes to say taxation, we are in the process of simplifying the processes, but have we reached the level that it happens in 1 month or 2 months? The answer is no. It takes at least 60 to 90 days for any substantial work to take place in India, in terms of say the ministerial work and the paperwork getting transferred from one department to the others. So these are things which demotivate private investors to some extent. I'm not sure if I should say that, like, if you look at, say, how the Vodafone case, had turned up, not something which a lot of people would, be interested. Then, it gives a wrong signal to the outside world. So that is something which the government has tried to, overcome. But how much of that will be successful in turning its image is something, it's a long process. It's not something which will happen in a very quick manner. So whether it was the Khan Energy or the Vodafone case or Hutch case, so these are there are a couple of instances which were not presented worldwide in a very good light, and that will definitely have its bearing in terms of the business sentiment. The present government is trying to turn it around by introducing your PLI scheme, by investing money in the infrastructure projects. So that in some way is good in terms of getting in some traction. But again, it's a very slow process for large scale investment projects coming out for India.
Yeah, they actually seem like really relevant examples for that. Yeah, coming to the next question, like as you were talking about the PLI scheme, although many companies' manufacturing unit have shifted from China, but India has failed to attract most of them, like despite having low corporate tax and the PLI scheme.
Right. Yeah. So the reason being is that it's like the first mover advantage. Who took the first mover advantage? Now, even when the companies were situated in China, there was still a lot of production of textiles or raw materials which were going from Vietnam to China, from Bangladesh to China. So there was a linkage that was happening from that side, and India at that point of time had not upped its game by that extent as much as say Vietnam or Bangladesh did. But now with this US China trade war going on, and when the companies wanted to move, at that point of time, Vietnam and Bangladesh had the first mover advantage because they were already producing some bit of raw materials for companies there, and hence they could get all those projects which India at that point of time was unable to. It is starting now, but probably it's a late start, and hence it's taking some bit of a time for say the Apple units to come and start manufacturing Apple phones, or other manufacturers from Japan and Korea are coming to India and starting their manufacturing. It's happening now, but we have already lost 2 years because obviously even COVID had come in between, so it was a delayed start there as well. But because of all of these reasons, India did not benefit as much as of now. But what is the likelihood of India benefiting? It's huge because of the way the government is taking up, PLI scheme seriously.
Yeah, well, we can just say better late than never, and hopefully, like India has a good future ahead. We have time for like just one question, so we would like summarize it. What roadmap would you suggest for someone from some completely different background to excel in the field of economics and finance?
Very interesting question. So here, what I would say is that if you look at Dr. Geeta Gopinath, she was from an economics background. She went ahead, did her master's, PhD in economics, and she is where she is now. Now, if you look at Dr. Raghuram Rajan, he was not from an economics background. He was an MBA grad, and then he went ahead with his PhD, and now he is, a well-known economist in around the globe. So it doesn't depend on where you are coming from in terms of your background if you want to excel in any field, and not particularly economics per se. um, Economics, I would say, is a bit more easier probably because I have some bit of preference for economics and I understand it to that great an extent. But if someone gets the hang of looking at data and has some bit of flair in understanding numbers and doing basic econometrics or some bit of modeling, I think you are good to go. You just need to have an understanding of reading what the model is saying. And if you're able to do that, irrespective of your fields, even an engineering student might be able to understand data better than what an economics grad can. Now, another example would be, say, if you know ISI's Indian Statistical Institute, that has more students from an engineering background than an economics background because of the mathematical base that that institute has. Even I couldn't get into it, couldn't get through that institute because of the high level that it has in terms of the maths quotient. So anyone can excel in any field. It's just hard work that you need to do, probably a little bit more understanding that you would need to do than an economics grad. But again, the world is yours. You can do hard work and just excel in whichever field you want.
Yeah, that's actually really motivating. Like, given all of us, like most of us from engineering backgrounds only. So hopefully, some of us can enter that field.
Right. And there is another interesting example, like our RBI governor. He was a bureaucrat, and he is now, governing the central bank at the peak pandemic time, and and doing the bestest jobs than any governor could have done. So that itself is an example that you don't really have to have that particular subject specialization to, proceed in that particular field. So yeah.
Yeah, totally. Thank you so much, ma'am. Like, in fact, we always just hear people coming up with their theories about COVID's effect on the economy and its future aspects. But having your session has really helped us all in looking at the broader image, and that too in like a really meticulously quantified manner. We hope the participants of Winter Consulting have been able to grasp how the theoretical concepts actually function in the real world scenario, and talking about like how COVID has actually affected India specifically. On behalf of all the 3,000 plus participants from Winter Consulting, we would like to express our gratitude for taking time from your really busy schedule to be our guest speaker. And thank you so much for your enlightening words.
It's my pleasure. And my last words would be just pick any newspaper and read through it, any business economics newspaper. And if you're able to understand even a small portion which you would not have been able to understand prior to this webinar, I think you've done a really good job, not only in this webinar, but even in terms of this course. Because I took a long time in getting to that level where I could read through a business newspaper. So if you're able to do that in your undergrad and grad days, that's marvelous.
Yeah, ma'am. Hopefully, all of us would be able to do it now. Thank you so much, ma'am.
All right. All the best.
Yeah.
Bye bye.
Thank you so much, ma'am.
All right. Bye.